Welcome to Pitcher Perspective. My name's Jordan Kennedy. Before we kick off, this is general advice in nature. Should you wish to seek personal advice, please reach out to your advisor. As always, it's great to welcome back Cameron Kirko, our CIO, back in the hot seat again. Cameron, you're looking a little tired. This time of year, you're busy. It's reporting season. Give us the highs and lows that we're seeing so far.
Yeah, thanks, Jordan. Look, it's been a wild one, really, in terms of highlighting key themes. I think this season's really been a mix of both big picture and little picture. So on the one hand, healthcare has been one of the worst performers this month to date, and that's really driven by the CSL result.
I was going to say CSL, what a swing.
Very much so, particularly because up until they announced, they were actually one of the best performers on the market. So it was a tough go in there. CBA was another one that's been a high flyer the past year, but the quality of earnings was somewhat questionable, and that saw the shares sell off. And the other thing we saw in this reporting season that kind of complicates matters is just the impact of the interest rate cuts, and that really lit a fire under certain stocks.
So as in the timing or the frequency?
I think it's more just the fact that it happened. Like, the market was scared a little bit back in July because everyone thought there was going to be a cut, and then the RBA was like, we need to see a bit more on the inflation numbers. And then we actually did get our cut delivered after some sort of disappointing economic data. And certain names, so your JB Hi-Fi, which sold off on the day of results, but is now
cracking
near back to all-time highs, and Bunnings owner Wesfarmers as well. We're going to be buying a lot more electronics. And
is that just purely 25 basis points discretionary spending, or people are sort of, were sitting on their hands, weren't spending, and now coming back to the market?
I think it's an expectation of a bit of both. Like, usually you do see some flow through from the rate cuts, and I think the other issue for Australia at least is just the housing market, and particularly new housing builds. Construction has been mired in low productivity and just real difficulty in getting developments off the ground. So there's a real hope that more rate cuts will flow through and lift up that space.
I know I've been back to Bunnings a couple of times for some sausages, so I think it is working, and we are seeing it at the grassroots.
Yeah, and I think the question is going to be just how much of it flows through to earnings, because Wesfarmers is now trading at all-time highs in terms of valuation as well, the share price.
Interesting perspective. So Cam, talk us through some specific highlights or lowlights for you that you've seen so far.
No, absolutely. So I think one of our portfolio stalwarts the last year, almost 2 years actually now, has been Origin Energy. And that for us was a play on the energy transition, but there was also a source of hidden value in Origin, and that's their exposure to UK energy retailer Octopus Energy, which has really lit a fire under the share price in recent months. And for context, what these charts are showing you is just the pace of growth in Octopus Energy in terms of customer numbers, as well as customers signed purely onto their Kraken technology platform, which is giving quite a lot of excitement for investors. And really, depending on whose numbers you read, it's accounting for a material chunk of Origin's valuation today.
Excellent. What's next?
So what's next? Just continuing on, I guess, with this sort of energy transition theme, it's the fact that gas is very much here to stay, and that was really the resounding call from APA's announcement. So for those that don't know, APA is Australia's basically gas pipeline operator for the vast majority. Very much so. And Pilbara now as well, quite recently. And what they were talking about in their report is just some expansion of the network over the next few years, as well as just when you look out for the next couple of decades, gas-powered electricity is going to be quite important as a swing factor. Reality is, until we get more battery coverage, we're going to need those swing producers for energy, and gas is really firming up.
So they're not fading away as quickly as what they originally anticipated.
Like coal, yes, like we're going to see increase in retirements that we have of the plants that we haven't seen already, but gas is really firming up, particularly on the cost side as well. Like, yes, we could bring in gas from offshore, which there's some companies that are trying to trumpet import terminals to the hills, but realistically, domestic gas we actually have
Got an
quite a
abundance.
lot of it.
Yep.
It's just a matter of extracting it. And so there's a lot to actually be fairly positive about. And we like it as a stock because you're getting an attractive yield that's
Yeah.
going to be increasingly franked, sort of 6% plus. And you're still getting sort of, low to mid single digits earnings growth. It's a pretty safe place to park some money.
Cool. What's next?
Now, this is where we go into the mea culpa moment. Not just us, like there's plenty of active managers in the market that would have had some overweight positions into CSL coming into results. And realistically speaking, the guidance miss was a big factor for the sell-off in the share price.
They got hammered.
They absolutely did. There were some other lagging aspects. So one was just the performance of the vaccine division, Seqirus. People in the States increasingly don't want vaccinations is the sort of short summary. It's actually a bit more complicated, but the US market is really impacting vaccine demand globally, and it also took another hit. So another stock we hold for clients internationally, Abbott, took a $100 million hit because USAID, which was defunded under the Trump administration, means these frontier countries aren't getting HIV vaccines anymore.
And are they affected by tariffs or the speculation of tariffs as well?
So the answer is potentially, but we think, so two things. So their key product are plasma therapies and that under the Behring division. Because there's such limited alternative supply sources for that, we would imagine that actually gets exempted even if some form of pharmaceutical tariffs comes into place. Secondly, CSL already have production in the US and they've actively talked about expanding
They've
that.
built their facilities, whereas others are to navigate tariffs, they're trying to build facilities in the US to circumvent.
Exactly. So they've got a few lines of defence. So we think they should be okay, at least on that front. But that notwithstanding, there are some underlying divisional issues that give some cause for concern. But we still think if you look at, vaccine demand, we're not sure how that's going to play out recovery-wise. If you do look at their core plasma business and even the Vifor division they acquired a couple of years ago now, that story is still reasonably intact and you're still getting an outlook for sort of, let's say, mid to high single-digit earnings growth, $750 million buyback program, some lowish dividend yield, but you put that all together for the current valuation of, sort of low 20s. Like it's probably a much more reasonable story than certainly some other pockets of the market we could point to.
Anything else on your list?
Really, I suppose it's more turning internationally. So I think the reality is, and we're starting to see it become more of an issue here, but this is really more a phenomenon globally. Like in Australia, for those that don't know, our tech sector is tiny, more of a rounding error, but you are starting to see companies increasingly talk about AI-driven efficiencies. And what you're seeing globally is just how much that AI narrative, the spending by major tech companies, is really defining where capital is flowing internationally. And a big part of that is just the CapEx expectations. So the chart I've got there is from Bloomberg Intelligence, and that's seen a more than doubling of CapEx for this current year, and the plans are for that to grow again next year as well. And that's really driving a lot of the flows. And we are seeing pockets of local success. So in Australia, the data centre plays, whether it's Infratil, NextDC, Macquarie Technology, are all benefiting from this. But it's also the adjacent sectors people don't talk about. Data centres need a hell of a lot of power. They need a hell of a lot of cooling. And they also need a lot of electrical hardware. And so there are all these other stocks you'd forget about, but they're actually seeing a material step change in terms of demand.
As one grows, the other grows.
Absolutely.
Yeah. So Cam, off the back of this reporting season, obviously we're partway through. What are we seeing as our key learnings to take us into the next 6 months of investing?
Yeah. Okay. I think key learnings are always a little bit tricky. We're not quite there at the end of reporting season, but I think some things are be very conservative on your guidance is a big one,
Yeah.
because if you miss on that, particularly by a decent magnitude, the share price reaction is catastrophic. And we've seen that a few times. So
Under promise, over deliver.
Guzman and Gomez was one. James Hardie was another one where you would have thought the scale of their miss would have been seen as material, but management declined to warn the market ahead of time. So I think that was one of the big things. Like, we have what's called confession season. We didn't quite have enough of that honesty this year, and it's really shown in the share price reactions to date. The other lesson is probably just on the AI front. Our economy's less exposed to a lot of these high-flying tech names, but it's interesting to see some sort of so-called old economy stocks starting to talk about the potential efficiency gains with AI. I think that's going to be a really interesting space to watch. I'd say with Australian businesses in general, where we tend to lag our economy is not as dynamic, and we tend to lag places like the States, but it's going to be a space to watch because ironically, some of those names might be some of the biggest beneficiaries of AI rather than where you would think like your high-flying, Mag 7 stocks in the US and the like. Some of these unheralded names might actually benefit a lot more because let's take a grocery store, right? They only make margins of, NPAT, like say 2s, 3s. If you can double that, that is a lot of profitability from just being a bit more efficient.
Yeah.
It's huge.
Cool. Thanks for listening in, everybody. Always interesting perspectives, Cameron. For those listening in, please like, share, forward it to your friends. YouTube, Spotify. Really appreciate you listening in. Hopefully we see you again soon. Thanks.